Okay, just give me a second to share my screen.
Okay.
You should have me now.
I see you. How are you?
There you go. I'm pretty good. You?
I'm doing great. Thank you so much for joining us this morning.
No problem.
Got a pretty loud crowd here for you, and you get 1 hour, and I'll be right here. I'm listening if you need me, and if anything goes wrong, but I'll be back right at the top of the hour to take the mic back from you.
Okay. Yeah. Well, I know where you are if I need my hand holding.
Yes. I think you'll be just fine. All right, everybody, give Peter a great big Trade Thirsty welcome. You have 1 hour.
Okay, thanks. Right, first, can you just do a quick sound check if you can hear me okay? I'm coming through loud and clear. Yes, good. Right, so I'm Peter Davies. This is my both my picture and the mandatory disclaimer as I'm in the futures industry. We do have to use disclaimers. This is a regulated industry. I'm the founder of Jigsaw Trading. This is me sitting in the seat of a professional trader on the floor of a trading firm in London. Now, does everybody know what a proprietary trading firm is, or do I need to explain that? Okay, I get yes. So I'll just carry on. So basically, the proprietary trading firms are people that I actually work with. And when I say work with, I mean these firms are our customers. So they use our tools that are focused specifically on giving them what they need to improve their traders' performance. And Nissa doesn't know what a proprietary trading firm is. Nissa, what happens is a proprietary trading firm, what they do is they go to universities, they find bright people, they will also take applicants, but what they do is they find people that they think have potential. They will then teach them how to trade. Sometimes they'll pay them a little bit while they're teaching them how to trade. Sometimes they don't get any salary, but it's a really low salary. And then once they've taught them how to trade, they will let them go on a sim account on the trading floor. And once they've proved that they can stay within the risk parameters, they'll actually fund their trading. And there's a split. It's usually like a 60-40 split that in the trader's favor. So they trade the firm's money and they keep most of the profits. So obviously those firms are very, very focused on trader performance, and they're very, very focused on getting their traders to profit. And they use our tools to help them do that. So we work with the managers, the educators, but most importantly, the traders at those firms in order to do that. And today I'm going to show you some techniques that they use, but I'm also going to teach you how they actually gradually improve their performance. So the trade that we're going to look at is what appears to be quite a scary trade, which is fading volume spikes, trading against fast one-way moves in the market. So we're going to discuss what to look for. We'll talk about how to enter, how to know if the trade is working or not. And in fact, we'll actually discuss the various outcomes of this trade, because it's not just a win-lose thing. It's a progression or a cascade of events in the market that happens every day that occur one after the other. So we'll teach you how to identify each one of those events as they occur. So these trades work when the market's going up or going down. So what I'm going to do is I'm going to talk about trades that are going to go down on a down spike. Just consider you can flip the rules around for an up spike. So like I say, we're going to look at why it works, how to recognize it, how to manage the trade, and then we're going to talk about how to make a setup work for you, because nobody can push the button for you. And if you're not yet profitable and you're trying to make sense of trading, this is a really great place to start, because it requires no indicators, doesn't need any long-term analysis. It just takes some time to develop your skills trading this one series of events. So you'll be able to spend the next few days, well, not the next couple of days, it's the weekend, but you'll be able to spend the next few days at the early part of next week validating that what I'm telling you today is true. And after that, it's up to you if you want to pursue it or not. So you don't have to take anything on faith today, because you'll be able to see it playing out in the markets yourself on Monday. Now, before we get into this trade, let's talk about what it is and what it isn't. So this is not a trade that occurs in any predefined location. In other words, doing some kind of preparation before the market opens is not going to help you with this trading any meaningful way. So you don't need support and resistance. You don't need trend lines. None of that will help. And there is a belief out there that trades must take some kind of top-down approach to start from the outside, longer term, higher time frames, and work your way down to lower time frames, you know. And I'm not saying that's a bad thing at all, and I'm not saying it's a bad thing to do analysis before the day starts, to have some preconceived ideas of where the market might react, but it's just not going to help you with this specific trade setup and it's not going to help with other trade setups too. So this trade is going to yield more than just a few ticks, but it is still a fairly short-term trade based on short-term activity. So we're not going to worry ahead of time about trying to identify where it's going to happen. It'll happen, you'll see it happening, and that's all you need to know. And a lot of trades are like this. It doesn't make them worse or better trades, the fact that you don't need to prepare so much for them. It doesn't make them more or less reliable. It just makes them different. So just keep in your head that if you've got it in your head already that pre-market prep or some kind of homework is mandatory before you sit down and start trading, just keep an open mind as we progress, because it is a belief that a lot of traders have. Now, saying that, there is still going to be some homework required before you can make this work, because this is a trade that works in a lot of market. It works in crude, it works in DAX, natural gas, gold, basically the more volatile markets. But in each of those markets, it works slightly differently. So your homework as such is to research on how this behavior plays out on your chosen market. And the key differentiators market to market with this setup are going to be the frequency of it occurs, the time of day it occurs, how many times per day, how many times per hour. So if you look at a market like DAX, on the DAX it's going to be multiple times an hour. If you look at gold, probably 3 or 4 times a day. Also, how often you get false signals will differ market to market, and what the tells are of a false signal. The amount of risk you would take varies market to market. Typical reward varies, and some very specific triggers for a trade do vary as well. And also what market state they work best in. On some markets, you're going to get the best results when that market slows down. On other markets, you'll get the best results when it speeds up. So before you start trading it, get to know it a little on the specific market you're looking at. And I know that most people just want to be told, just show me where to get in and where to get out. And if that's you, and you've been at this for more than 12 months, just consider the merits of kind of taking a step back to study before you dive in. Get to know it first, start trading it, because that's what the professional traders do. And that's one of the big differences between professional and at-home traders, is they'll get to know something first. And that getting to know it process that we'll talk about at the end builds your ability to recognize patterns in the market through observation and actually gets you ready for live trading. So the behavior we're going to look at is actually quite simple. So this is the why of the trade, and we'll look at how shortly. So at the risk of stating the glaringly obvious, a market moves down because a lot of people are selling it. And on most days, the majority of trading that we see is short-term speculation. We don't know the exact mix of short-term and long-term, and it changes when there's news in the market. So let's just agree there's always short-term and long-term players in the markets. And the long-term players generally aren't going to react to short-term price moves in the market. So on a short-term basis, if we're trading intraday, we know that future short-term moves will occur when short-term players react. So if it's only short-term players reacting to short-term moves because the long-term players don't care about them, you can actually pretty much forget the long-term players a lot of the time when considering how the market might react to these kind of shorter-term events. Obviously, the exception of that is on a news-driven one-way day with a lot of long-term repositioning. The kind of days you get off a terrorist attack, some big economic news, company going out of business, a big legal thing. Those tend to behave differently. So anyway, as the market moves down, what we see is the number of net short positions in that market increases as the market goes down. In addition, the people that are willing to sell more decreases, because basically, people have had their fill. They've reached their maximum position size. In other words, what you see here is as you move from left to right, is we're gradually building more and more people that need to buy to take a profit, right? All very obvious so far, but there is a little bit more. We're all speculators here, right? And as speculators, none of us care if the market's going up or down, right? We just want to be on the right side of the market, whether it's long or short. So when you think about other people in the market too, is it logical to assume that they're the same, that they really don't care if they're long or short? They just want to be on the right side of the market, and that they're just there to exploit the moves. And I think that's a fair assumption to make. So what we want is for the market to go down and to get into a position where there's not many other people that want to sell, okay? And that will see them start to buy, visible, okay. So when there's not many more people to sell, then what we're going to see is that people will start to buy to unwind their positions. And what that does, it gives you a pop to the upside. It's a stop run. What will cause the market to really move, though, is when the majority of speculators simply believe that the path of least resistance, where the profits are, is to the upside. And that's where a continuation comes from. So ideally, what we want to see is a market that moves down, and then a market that pops to the upside, hopefully after we've got into the market, and then see signs that speculators have decided that, you know what, we really think the path of least resistance is to the upside. And that's effectively what we're looking for. Now, as I said, what we're actually talking about, you could call it a trade setup, right? And that is one, it's a valid term, but what it also is a market behavior, right? So we're trading a specific market in behavior, and there's a cascade or a series of events that happen with this behavior, right? So first thing we're going to see is we're going to see a volume spike with some indication that there's traders trapped at the close to the top or the bottom of that volume spike. And then we're going to see a pause, and this is very, very important. A pause is indicative of the market taking a short breather, a rest, a reassessment, right? If the market stays wild, it hasn't settled down yet, and people really haven't had time to take a step back, right? So this pause is time for those that entered at the top of a spike up to consider their plight. Now, we all know that markets don't move in a straight line. So here's the rule of thumb that I use, right? At the end of a spike, the market needs to have a sudden reduction in volatility. So if the market moves up aggressively and then it moves down just as fast, you do not have a trade, right? It's quite likely that market's just going to carry on what it's doing, right? The market hasn't changed. But if the market pauses, people actually slow down their trading, people reassess, then we have our pause, and we know that it's more likely that there's traders at the extreme of the spike that really have time to consider that it might be caught offside. And then we have a pop, and that's the stop run. That's the first sign that traders that got in right at the end of the spike are now getting stopped out of the market. And then the market pauses again, and it's almost impossible for it not to pause, because when you get a stop run, it's a small, fast move triggered by stops. And once those stops are triggered, of course, the market's going to slow down and calm down a little bit. And then the next phase is a continuation. It's when people can say, well, look, all those guys who've got stopped at the end of that move there, they've, got in at the end of the move, they've all been stopped out, right? And you know what? Maybe that move's over, and now the market's just going to move in the other direction, right? And that's when we start a more measured, progressive move with a lot more potential. Okay, and here's an example. Now, I'm going to I don't believe in using clean charts that make everything look lovely, because that's not what happens in the real world. And what's going to be clear at this point is that the way that I trade this series of events isn't the only way, right? You can enter the market any of these phases. So what we've got here, we had a market moving sideways, and then we see it spiked up. It just pushed up really, really quickly with really, really high volume, exceptional volume. Now, you can say how much volume is high? And the answer is just lots more than we saw previously. So you've got this exceptional amount of volume, market's really spiked up. And then there's this circle at the top, which represents an abnormal amount of volume traded up there. Okay, so this is where your trades are stuck. Next, we now see an aggressive pop down. And basically what's happening there is that a lot of the traders that got in on this move up are now getting stopped out. Okay, now this pop down is actually quite a lot bigger than you usually see, but anyway, it's, all charts are different. And then you see the pause, and this is the pause here, right? So we've seen the market pop down, and then we've got a pause, a tiny little pullback, and that's where, the market participants are saying, well, what's going to happen now? We've pushed up as hard and as high as we can, and we've fell down hard, and now we've got a pause because, stop runs don't last forever, and you could enter the market there's no reason you couldn't actually enter the market at this pause, not where I get in. And then the next thing you see is a continuation down. And you can actually see that in this case, it's still a fairly fast-paced move. But you can see that this continuation down here is a much more measured move than the initial stop run. Okay, so those are the four phases on a historical chart. Let's just have a quick look at what that's going to look like in real time. Now, for those of you who don't know the jigsaw tools, these circles here show areas where there's excessive volume traded, and the volume bars are here below. So the volume is blue and red, indicating the proportion of buyers to sellers. So there's a lot more buyers there, and the blue and red here also indicates buyers to sellers. The price bars here, red and green. Red means there were more sellers in that price bar, and green means there were more buyers in that price bar. So we can see that, here on the circles in the green bar up, basically we're kind of overweight on the buy side, a lot more buyers than sellers. Now these gauges over here show something called the pace of tape. Pace of tape is basically the frequency of trades hitting the market, right? And as you can see, it's right over on the right hand side. It's right redlined on the right, just representing that it's just this move up. It was just full of excitement, just loads of buyers piling into the market, everybody excited, everybody thinking they were going to miss out. So what are we looking at here? Well, it's a sudden, extended, explosive move, huge amount of trades. And as we get to the top, we see the circles, which means at the top here, there's a lot more volume trading at these prices than anywhere else on the chart. And what that actually means, it doesn't mean that suddenly more people traded. It means it's taking more volume to move through each price. So normally you can see I might have taken 188 contracts to move up, and then 120 to move up, and then 42 to move up, 44. And then you've got this area up here where there's a lot of contracts traded. So when there's a lot of volume at one price, it means that basically the market's getting stuck, right? And what we see here is very typical, basically. A bunch of traders jumping on board at the end of a move. So you can see the stuck traders also on the tape here. Look how many: 6507, 6507, 6508, all buying, all getting no love for that buying. So plenty of large buyers, prices moving down. And of course, you know what it is. Can I ask, has anybody been on the wrong side of a volume spike and bought the top of a move or the bottom of a move? Because I'm pretty sure, yes, sir, right, Carlos, everybody's been on the wrong side of this. I feel almost silly explaining what's going on, right? But it is fear of missing out, right? All of these guys on the way up actually thought it was going to go up forever, right? It's fear of missing out, and it's something we've all experienced when a market runs away without us, right? So we saw the volume, we saw the large push up, we saw the pace of tape, excessive amount of positions at the top. Now what do we want to see? After we've seen this push up, we want to see these traders getting stopped out. Or we want to see an attempt that somebody's trying to stop those traders out. So we're looking for these positions to get run over, for the market to move down through those positions, and for us to get a small pop as they got stopped out. And what we can see here, this is that initial pop, right? This is effectively that push down when some of those traders are getting stopped out. After that, we know the market's going to move sideways a little bit, and then we're going to start to get a continuation. So what we're looking for is simple: an excessive move with a lot of volume in the overall move itself. By volume, I mean volume overall here, and then some clusters of volume at price, and then for those trades to get stopped out. And that's the easy bit. The skill is to develop is identifying when the market's about to stop those guys out. And that's where your win rate on this trade is going to go up. And also to get out quickly when you're wrong, whether price moved against you or not. Okay, so here's a fairly tame volume spike on gold. So what we can see is after a period of moving sideways, the market is pushed down, and we can see we've got a much larger volume of trade than anywhere we've seen earlier. We also have one price where we trade an excessively large amount. Now that doesn't have to be one price, it could be several prices. What's important is that we have an area of high volume, an area with a lot of positions in it. That's the juice for the pop, right? So there was some excitement on the way down. Very likely people got positioned because they thought they were missing out. And now, as we can see the market 1, 2, 3, 4, 5 ticking up 5 ticks, obviously anybody who bought lower down is going to be getting nervous because you've all been the person there and you've all got nervous, right? So we can see the volume traded at each price here on the way down: 49, 36, 24, 49. It was all much higher on the sell side than the buy side. And on the way up now, we can see 69, 53, 52. You can see it's mixed, but it is moving up. Now, if we look at the large traders on the tape, that's also pretty mixed. So actually at this point, I don't really see that the buyers are really kind of coming in and trying to take this market up. And that's what you want to make sure that you're doing. You really want to wait for the buyers to come in. You're going to get in a little bit later, but you're going to pay, that getting in a bit later is you paying for the confirmation. It's you paying for a higher win rate. So what you can do anyway is you can enter below the circle, at the circle, above the circle, but you want to see some aggression. So I don't care, to be honest, if I enter long above or below the circle, to be honest, but this is the tipping point. These are the traders that are going to get stopped out. I care more about confirmation than the exact entry price. Now, this is gold. It tends to run. I don't need to buy the exact low. Now, as we move on, we can see it's just changed a little bit. We've got this flood of large buyers here. And one of the things you can't really show on a screenshot is kind of the pace that they came in. So what we're seeing here, we're only seeing 10 lots and above, and that is those are fairly large traders on crude. And my take, just seeing the way they all came in at the same time, is that they're now trying to run the market up. And this is where the skill comes in. So if buyers are actually hitting quite hard like this and getting some price progression, as we can see, they're getting price moving their way, it's actually hard for the market to fall back in the short term. So I'm going to try and get in with a limit order because it's a fairly thin market. I should be able to get in with a limit order. And as long as we see buyers like this participating, we don't see any sellers coming in, I don't see how this can possibly move against me in the short term. And that's just basic tape reading skills. Now, I want you to remember this bid at 82 because I didn't get filled there. And that's just down to my particular trading style, right? Buyers did come in aggressively. I was trying to be cheeky and get a good price. Market ran away from me, but you know what? I don't care because these are trades that tend to run. I'm not going to say I missed the move because of 3 ticks, right? So I got in 3 ticks higher, fine. We saw then this nice little push up here, right? We didn't see a ton of traders trapped. So again, the actual push up, the little stop run is going to be a little bit smaller to reflect that, right? It's pretty clear where the late sellers were stuck, this price and around here. And now we've had a pop up. We can see people have got stopped out. We know that, come on, there might be some bag holders at the bottom still, but you know, most of these guys are going to be stopped out now. And what we want to do now is say, okay, well, we've had the pop, we've had that initial reaction, we got on side in the trade, but are kind of the overall, is the overall consensus in the market now going to be that the upside is the path of least resistance, right? And that's what the next step in this trade is. So if we start to move sideways for a long way, it means it's uncertain. If we continue to start to just tick up, 3 or 4 ticks from that price there, then it means in the short term, yes, it's very, very likely that the upside is the path of least resistance and people will just buy more than sell. Means the market is fully likely reversed and we're going to see some good upside. And you can even get in at this point. There's absolutely nothing wrong with getting in when the market moves sideways after the pop, right? So the pop here is when the guys at the bottom, at the end of that spike, get stopped out, and then you have a pause, and then the continuation is simply when the bulk of speculators feel it's just easier to the upside. People have to pick a side, right? And after that, it just makes the other side just that little bit easier. I mean, if you think about the people who got caught out selling on the way down, they're probably not going to be so aggressive about selling either. So it's just like, if you just lost money doing something, are you going to turn around and do it again? Okay. And this is where we got to in this market. Now, when I first looked at that spike down, the first spike down, I said it was actually a tame spike in crude. And if you look back now, it does actually look that first move out of the range. It actually looks really small, doesn't it? It's small on the volume chart. And on that first pop, we'd actually broken out of a range and pushed down. In this case, we've got another volume spike, right? And what we've had is a volume that's spiked after an extended move. And this is actually often a better trade. It's quite common for traders to kind of get caught up in the excitement of a move. We've all watched the market move up and up and up and up. And with each push up, we just feel like we've missed out and you can bear it no longer. And then you finally buy and the market immediately reverses and stops you out, right? So we know if we start pushing down now, late buyers, we've got a few more late buyers here from this area, are going to be feeling very nervous, as we all do when we buy at the top and it moves down. Then the earlier sellers that are still the earlier buyers that are still holding from the way up, you know what? They're going to say, oh, it's probably done. I'm going to start to take profits, right? This isn't really rocket science that I'm talking about now. It just might be putting things in. I'm sure I'm just putting things in your head that are already there. But make no mistake, selling at this point is quite scary, especially if you haven't really studied it well. So the market's just put in a big fast move up, and selling big fast moves up is not comfortable. So we do need that confirmation by seeing some aggressive sellers come in. And what we can see we've had some aggressive sellers. You can see on the big trades here from 284.5 to 284.0, they've actually got the market moving their way, while at the same time you got big buyers have got the market moving against them. And that's just one of the things with order flow that just helps tip the market in your direction. And this is something that repeats itself over and over again, 3 or 4 times a day in the first couple of hours on crude. Gold, not so often. DAX, good grief, all the time. Happens all the time. Anyway, let's just review the spike behavior. Stage most of you at this right now is you've probably seen this happen a number of times. I'm just going to have a couple of questions. That wasn't a tick chart. That's actually a 10-second chart. I'm trying to look at the market really zoomed in. The grey boxes, that's showing the market depth. Somebody's asking. So the market depth was 1285 here was particularly high. You can also see the 142 here. So you can see that's what the background is. Above volume, that's the cumulative delta. And we don't show advanced declining issues. It's too long term for this type of trading. Anyway, I'll move on quickly and review the spike behavior. So the stage most of you up with this right now is that you've probably seen this happen many, many times, and maybe you've been caught on the wrong side of a spike a number of times, buying the high or selling the low. And most likely you've stayed away from trading against spikes, thinking it's a dangerous time to trade. Can I ask, has anybody here previously thought of actually trading against a spike? Or have you been too busy trying to buy it? Anybody try to sell a spike before? No. Stephen, good for you, Stephen. Good. It's good to see some people doing that, because you know what? It's just a behavior in the market, right? And I can tell you this from the professional guys I know. All they do at professional firms, there's not many secrets about this. It's really silly. They see things happen in the market, right? You've all seen volume spikes, right? They see things happen in the market over and over again, and they try and figure out how to take advantage of them, right? So for the guys that said yes here, I think it's really cool, because you've seen it happen. You might got caught on the wrong side of it. And instead of just going to a book or an online forum and for a list of setups, you said, I'm actually going to try and trade that because it's a behavior I can see. So with any behavior, most of you, you've probably seen this happen many times. A lot of you, I'm sure everybody's been caught on the wrong side of it, because I know I did loads of times when I was starting, buying the high, selling the low. But you've probably stayed away from it because you think it's a dangerous time to trade. But it's just a market behavior. It's not really dangerous anything. It's just a behavior. And as traders, all we're trying to do is take advantage of behaviors that repeat. The previous presenter even mentioned that himself. So first we have this aggressive, fast, extended move with lots of volumes. And those terms are relative, right? And they relate to the behavior prior on the move that day. So it could be a 200 tick break or a 30 tick break, just depending on the overall volatility for that day. Then we need to see one or more price where there's a lot of volume close to the extreme of the most recent push, an area with a lot of volume over a narrow range of prices. And that volume is basically a tipping point, because it's the traders in that area that are going to get stopped out. Now, if it carries on up, they could get stopped out to the upside or the downside on any spike, right? But we're looking for them to get stopped out by the market moving in the opposite direction, right? You could, in theory, play a continuation trade off the spike, but it's just not something I've really looked at. I've really looked at just fading the spikes. So we need to see one or more areas with the high volume, and you're looking for that people in that area to get stopped out, and you're trying to identify when it's the side you want to get stopped out. So you have a push down with volume close to the extreme, market pauses, traders get to see that the market got overextended, and then they step back and they go into wait and see mode. So the kind of pause, is really important, right? Because if you think about it, if the market just goes wild, it's just going wild. It's not changing behavior, and people are going to stay with the trades, because if it's been going wildly up and down on the way up and it just carries going wildly, swinging 4, 5, 6, 7, 8 ticks, it's not doing anything different. But once, if it really spikes up and slows down, everybody can see it's changed, right? And that's what gets them thinking, right? So you need that pause, that reduction in volatility, partly because it's also a safety net as well, because if the market slows down, it won't run against you as quickly. If the volatility doesn't go down, market stays very active, just stay away from it. There will be another spike, right? And it might even turn out to be a winner, but you'll be better off staying out of the way. So, with the markets don't move in one direction, and we don't want to presume that every pullback is a reversal, right? We want to see a behavioral change, a pause. Then you got the pop, which is the first sign that your trade is going to plan. So it's a rapid move your way when the traders at the tipping point get stopped out. Now, you could enter after the pop, because the pop is what signals the start of a little pullback. And now think about it. I'm not trying to talk about abstract concepts here. I'm talking about real traders, what they're doing. So when the market pulls back, when the market pops, it's because stops are getting hit, stop orders. At some point, you're going to run out of stop orders. And people don't physically click as fast as thousands of stop orders get in triggered, right? So you get that pause. That means the stop run's done, and that's key. But basically, the sellers, on a pop down, the sellers have had it all their way on the way down. Now you've got sellers got stopped out. Sellers that probably won't be too keen to sell again straight away. And it's also when other traders like us start seeing potential to the upside. So it's just helping to tip that balance in the opposite direction. Now, if you scale out of trades, if you trade multiple contracts, the end of that pop is a good time to get out of your first target. So even if there's no continuation after the pop, you've made some profits. And you know what? Sometimes there's no pop at all. Sometimes the market spikes, go sideways. Get out of the trade. So this is one of the trades where if you do see, if the market spiked down and you see buyers start to push against them, the reaction should be pretty quick. You should be within a minute or two. If you're still sitting there an hour later and it's going sideways, it's not a volume spike trade anymore. So the second pause appears because, like I say, stop runs don't go on forever. So the market naturally takes a breather, and it's normal to tick back a bit. So it's a small range or a pullback that generally lasts a minute or two. But again, like I said earlier, different markets do different things. So I don't trade volume spikes on every market. I know they're slower on gold, but I don't trade them on gold. I know they're faster on DAX, but I don't trade them on DAX. Now on DAX, that small range or pullback will not last a minute, right? On crude it will. On gold it might be 5, but I don't study it. And if you want to do this on gold, which you can, it's a great market for it. Especially if it's the market you already trade, then just watch it and get to learn. Generally speaking, how long it waits before they pile in again, because they will pile in again. Once that stops runs happen, it will pause, and they'll just start pushing it. They're pushing it, and there's traders there that will push the market just to kind of get the ball rolling, so it snowballs and then starts moving up. So once you start to get movement back in your direction again, you're going to start to see lots of traders come in, the braver ones earlier, the more cautious ones later on, and they're just going to get in and go with the flow. Now, of course, like any trade, you've always got to keep your ear on the news, because you could have news come in and move the market against you. But obviously, as the trade progresses, you get higher and higher chance of good continuation with each stage or phase of the trade. And here's the key, right? You can get in any time. This is just the behavior, right? I have to talk about anything I trade from my perspective, but there's no right or wrong with this. So different people see different things. You might find that first pause is where you want to get into this. So if you find yourself master at spotting that continuation, that's the trade for you. If you can't spot when aggression is coming in to stop traders getting stopped out, then it's not for you, right? So study the behavior first and decide how you want to trade it second. Now, I will just go over a few more questions. Andre's been trying this. Great, Andre's. Been experimenting with it on crude. Bruce, not often successfully. Well, Bruce, Skype me, let's have a chat. ES and NQ this week. Well, S&P traditionally is not a great market for this, but it is at the moment because it's so volatile. NASDAQ, very good. I would say NASDAQ's a little bit too fast at the moment. Volume leads price, TJ. Well, I wouldn't say volume leads price. What I would say, aggressive buying gets people to stop out. So there is, I would say order flow leads price. But if you're looking at volume bars, sometimes the amount of volume it takes to move price up won't really be visible on the volume bar. So that's why we use the tape and other, order flow tools. Is the pause exhaustion? Absolutely. So we're running out. The pause, TJ, is exhaustion. We're running out the first pause. When the market reverses without any pause, it's not that it's not reversing, Paul. It's just that nobody's had a chance to see that they're offside. It's just, generally speaking, when a spike moves up, it's going to be moving up. It's going to be back ticking on crude like 5 or 6 ticks and up 10, down 6, up 10, down 6. It's going to be like stair stepping its way up, but very quickly. So you don't want to take a little 10 tick spike back as a trade. So to me, it's not that there's nothing decent happening. It's just I can't differentiate between the rapid pullbacks that work and the rapid pullbacks that don't. Now let me just does this normally work in FX? Absolutely, it works in all markets that have got good volatility. Basically, you would not do this on interest rates, for instance. Anyway, let's move on. I will answer some more of the questions. I can see them. I'll come back to it. Because it is a fairly simple setup, but there is a catch, because you do need to do something else to make this or any other method work, okay? And I am talking from the authority of the customers that I have, right? This isn't really from me, but I can tell you what they do, because there's a difference between understanding behavior and profiting from it. So most traders decide at some point to go out and buy a trading method. I get emails all the time saying, Pete, I don't want to bother with all the theory and why and all that. Can you just tell me where to get in and where to get out of trade? In other words, they want a pattern, a signal to get in and out that they can repeat without worrying about why it works. So to a lot of people, trading is all about technique, about what to do, and not so much why to do it. And the reality is trading is actually all about understanding a market behavior and then applying a technique to profit from it, which is why today I've been talking primarily about who's getting stopped out, what's the emotion, why are people doing this, because that's what's important. So for instance, if you know a market behaves a certain way 80% of the time, but your trades are only 20% profitable, right? So you might have a setup that's 80% working, but your trading is 20%, right? What you've got a difference there is the difference between your understanding of market behavior and your ability to execute, right? So getting a setup on its own is it's really, really difficult to make. I don't know anybody who's just been given a setup and it's made it work. So you have to understand how the market behaves, and you have to understand whether any problems with that setup is down to your execution or the market behavior, because most people don't know. So the idea, anytime when you review your performance, right? So let me ask you this, right? For every time you take a trade, right, you should be able to answer a very simple question for every trade you took. So for any losing trade, can I ask you, do you know the answer to this question for every losing trade you take? And the question is, was it me or was it the market? Do you all know that for every losing trade, whether it was you or the market that caused that loss? Got some yeses? No. A lot of people is no, right? You don't. So in other words, you might have a good setup, the market's good, but you're losing money because your execution's not very good. So you need to know, am I trading badly because this particular setup is new to me and I need to develop my skill? You need to know, am I trading well through sheer luck? You need to know, am I trading well, but the market's just not behaving as expected in the short term? So you need to know basically, do I suck or does the market suck? Or does my analysis of the market behavior suck, right? And 99% of traders I talk to cannot answer these questions, but every successful professional trader I know does, right? And we're going to look at how you actually get to do that, right? Okay. So for some people, this is the missing link, right? So if you only take one thing home today, take this, right? The reason that people try so many things is because they don't know this. They only have one measure, whether they are profiting or not. And this is the key for making any setup work for you and to allow you to trade with confidence, right? In fact, this goes for any setup. So if you want to make this work, and I really mean this really make this work, or any other setup you've been looking at, right? This isn't specific to volume spikes. Spend some time observing that behavior in the market. Build up a profile of the market behavior, which is what we have left. We have left the result of me watching volume spikes on gold until it felt like an old friend, right? Now, I don't trade volume spikes in gold, but I just wanted to sit through and get a feeling what it does, right? So I know when it occurs, when I'm looking at it, what I'm looking for, you know, how many contracts I'm looking for, what the failure rate is, what the upside generally is, what the downside is. I know all about that, about a setup before I even start to trade it, right? And this gives you knowledge. It gives you an information edge over other people trying to buy trading systems. And with this knowledge, you then refine your execution plan, which is what we have on the right. So we've already discussed ideas on when to get in, but this is where you'll refine the plan and your expected win rate, and then decide how you want to trade that behavior or not trade that behavior. So if you do this for any setup that you have, you might decide you throw half of them away, right? Or you might decide you have one that's really, really great, but you're just not very good at executing it. But anyway, with this, you can measure every trade you take. You can know whether the behavior worked and whether you traded it well. And that puts you ahead of almost all retail traders who only know one thing: did I win or did I lose? They never consider why they won or lost. And unfortunately, that isn't all you need, right? So can I ask a question again? And I will go back up to the other questions early on. Has anybody here had a setup that worked and then it stopped working? Okay. Stephen, I feel quite sad for Stephen. I think Stephen needs a hug. He's answered yes to every question. Right. That's absolutely normal, and it's just simply a side effect of the fact that the volatility in the markets changes over time. So even when you have a setup that works, you absolutely have to keep an eye on the volatility and adjust accordingly. So consider the volatility we've seen on the S&P 500 first 3 or 4 months. I mean, unless you've been living in a box, right, you should know the S&P has been wild, absolutely wild ride here. And what we can see here is the VIX for the past year and a half. And the VIX, if you don't know, is a measure of volatility. And you can see, you know, this is kind of average volatility. Well, this is a bit low, actually, 10. Usually between 10 and 15, you know, 12, 13 is decent. So, you know, it was a little bit low here in 2017. And then 2018, about average. But look at the spikes up. Look at the spike up here, the spike up here, right? That's just a reflection of the volatility in the market, right? So you can see we generally have, all the way along, we got these little variances. So small adjustments, little variances, and then these massive ones here, right? These changes represent actual changes in the way that the markets are moving. Changes in the potential rewards for every trade you take, and changes in the amount of risk for your trades. Now, if you really want to make money trading, you absolutely need to remain flexible and adjust with the markets. Now, it is not particularly difficult, right? So what I'm talking to you is not rocket science. It's just something that a lot of people don't do, but it's an essential. If you don't, whatever you do will stop working, and you will not be equipped to do anything about it, okay? And like I say, it's not that hard. It just requires having a process where you're constantly evolving, just like professional traders. Now, I meet traders from all walks of life, and this is how I break down the various stages of the traders that I know, right? I don't know anybody that makes that can make more than $100,000 a day. They may be out there. I just don't know them, so I'm not going to talk about people I don't know, right? So I meet traders from all walks of life. This is how I break them down. So I know guys who are keeping massive losses from their wives, right? And people in that position I try to avoid, because they're trying to do a lot more than learn how to trade. They're trying to dig themselves out of a desperate situation, which isn't a good place to be as a trader, right? As we move along, we've got the beginners. We've got an interesting bunch of people I call damn commissions, and these are people in prop firms. A lot of prop firms trade spreads where the fees are higher, you know, because if you're doing a spread, you've got like a buy side and a sell side. You pay commissions on both, right? And there's a lot of people in prop firms, especially doing interest rate products, which have been dead for a while, that are doing okay, but they really can't make it much past their commissions. I would say they're probably better than most retail traders. Now, the first profits in a prop firm come usually, they'll give you 1 or 2 contracts a day. usually looking for you to get $200 or $300 profit a day, right? Very small focus in terms of markets, very small focus in terms of setups, and you've got some guy watching over your shoulder, ready to pull the plug if you have a bad run, right? Now, the interesting thing here is these first profits, $200 or $300 a day, they're going to give you a loss limit of $1,000, but at any decent prop firm, you could have a bad day where you lose 5K and they won't kick you off back to sim, because they'll look at the volatility of the market. And if the market's been particularly tough, they'll give you a bit more leeway because everybody adjusts with the market, right? But anyway, you're there making a few $100s, ready to pull a plug if you have a bad run. Now, as prop traders progresses, a lot of the guys get to where they can put in 2,000 to 4,000 on a good day. And then you get the advanced guys, people who can regularly make $10,000 a day. And after that, you get the outliers. Now, these are guys I've met. I've met some exceptional traders. You've all heard of what's this famous, the flipper. If you haven't, go and look at the flipper. I've met a few guys. I met one guy who was 30% of one of the markets in Singapore. So he's 30%. His trading was 30% of all volume. So these are the outliers. These are elite traders. I've met guys that can make $100,000 on a good day. And there's a reason I'm telling you this. But first, I'm just going to prove it to you because it seems a bit of a wild claim. So here's the actual results from a trader at a prop firm. And this is a prop firm that uses our tools. This is live trading, real money, $88,000 profit in one day. Now we'll just go across to the win rate. Right, number of winners, 39, number of losers, 35. And that's another myth busted. I can tell you that most of the prop firms I work with, a win rate of 50% is pretty normal for the elite traders. They're not trying to be right at all. That's not what they're trying to do. They're trying to get into trades with great risk-reward ratios. If we look down, this is one day. What's he trading? He's trading currencies, crude, S&P 500, European interest rates. Go down here, he's trading the Mexican peso. In that week, he clocked in profits of $243,000. Now, I'm not saying that you're going to get to the point where you'll earn $100,000 a day, right? But if you stop and think about it for a moment, this does teach us something very, very important about being a trader, right? Who do you think taught him that, right? Who do you think taught this guy how to earn $100,000 in a day? Who teaches that skill? Where's the classroom, right? Because if there was a classroom that taught that, we'd all go, right? And I can tell you who taught him to do that. Nobody. Absolutely nobody, right? What happens by the time they're hitting this level here, these levels here, the traders have pretty much outgrown the person that taught them how to trade. And the reality of trading is simply this. By the time they get to here, even the 200 or 300 level in a prop firm, they already know most of the theory. They've got a bunch of setups. And whilst there's certainly some mentoring and hand-holding to get them to the upper levels, they're mostly responsible for their own development as traders, right? So right from this point here, right? In fact, before this point here, these guys in these firms have to do what I'm going to show you now. Okay, they learn a technique, they trade it on sim at first, and at the end of every day, they review what they did right, what they did wrong, what worked well, what didn't work well, right? Everybody wants to have a magic bean solution for trading, right? There isn't one. If you're working to a prop firm, the guy's got time, buy a guy from a prop firm a pint, right, or London or whatever you drink in everywhere else, and they'll tell you how he trades. If you sat down the next day and tried it, you'd fail miserably because you have to go through this cycle. You have to, okay, I tried that technique. It didn't do well. Okay, what did I do wrong? So if you're looking for the real secret of the most successful trades on the planet, this is it. It's not a set of secret levels and not a secret technique. It's simply a process of constantly looking for improvements and things that might be impacting your performance. And that could be things like the volatility in the market. It could be things like you're closing trades too early. It could be things like you're going crazy. Sometimes sometimes you get into this state of mind where you just go off plan. And this basically is where we at Jigsaw excel. We have a professional level education, most of it free to customers. We've got a trading platform that you saw today that focuses purely on the things professionals use in their decision-making process. And we've got the most advanced automated trade journaling and analytics system that exists anywhere. So it's a system called Journalytics. Now, you get all those things with Jigsaw. Each of the components that we have is designed basically to keep you on this path. Now, I know there's people here that you're just not ready to do this yet. You want to be clicking buy and sell all the time. You're not ready to spend just 15 minutes at the end of the day just to say what went well and what didn't. But there's going to be people here who've had enough of not progressing and want to get into this. And for those people, that's what Jigsaw's for. Now, we've got two packages. We've got independent and professional. Both come with 10 hours of the best order flow education around, education that's been used by professional firms as well as those at home. They both come with lifetime access to the trading platform and lifetime access to the analytics. You also get access to our daily chat room where you can chat with like-minded traders that also use the tools and techniques, and me a lot of the time as well. Now, the professional, which costs an additional $300, comes with some additional amazing educational videos, topics such as trade management, scalping, volume profile analysis, much more. And before I go back to the questions, I offer for you today, get on board with the revolutionary set of products that are really keyed into the development cycle as a trader so that you actually improve every week and every month. And if you do that today, we'll save you $300 by letting you have the professional package for the price of the independent. It's a $300 saving just for the next 20 people and just for the next 48 hours. Now, I'll just give you a link for that. There's a link to jigsawtrading.com/TradeThirsty. If I can put that into the Q&A, and I put that in the chat as well, I think. Put that there. Basically, if you're not getting where you need to in your trading and something resonated with you today, it's just time to take a more professional approach where you understand that the setup is an important part of it, but there's a lot more to do to make that sing and dance for you. And with that, let me just go back to the questions. 2 weeks to becoming a trader presentation. Yeah, you get that in there. How do you teach it? It's all done by video, but everybody that comes on board gets my Skype ID, also gets my email address, gets access to the chat room where you can talk to me. We don't do stocks at all. It is all futures. Prop firms recommend, TJ, if you're at the point where you're ready for a prop firm, it's probably, I don't want to give prop firms names and addresses out. It's probably best to PM me and we have a chat about what you're looking for. Somebody's asking, is this all based on day trading? This is all based on day trading. Tiffany's saying made 2,500 to 3,500 for 3 days. On Friday, thinking about swing for a few more days and you wiped out. Yeah, you've got to get on that consistency path, Tiffany. It's got to be like a real, this is what I'm doing and I've written it down and this is how frequently it occurs. And what you did there, you had something that worked and then you said, I'm going to do this. And it's just an irrational thing, and it's just a part of the mental game that's trading. But if you made money for 3 days doing something, and on the fourth day you did something else and gave the money back, you know what the issue was, right? But it's partly an overconfidence issue because of the 3 days, but it's also an underconfidence issue because you don't have the statistics on that setup to realize what the payoff's going to be over time. So it kind of makes you worry. Average number of trades a day, Tiffany, it just depends person to person. I know prop traders that take 5, and I know prop traders that take 80. I'm just going back up. And important to make a distinction between losses from the market and losses from making it. Yeah, it is important to, absolutely, Jeff saying it's important to make a distinction between losses from the market or losses from making execution errors. Really important. Whatever you do, honestly, whichever new trade you pick up, you will close all your trades early, right? I've never met a trader that got the most from a setup right from the off. So what Jeff's saying there, it's important to make a distinction between losses from the market, which is what's the market making available or not, and losses from making execution errors. Brilliant, Jeff. I should have said it like that. I could have saved 10 minutes. And yeah, Michael, yeah, it's true. If you followed the rules, it's the market. If you didn't, then it's you. That is true, but there's a lot of shades of grey in there. And what I'll do, because next speaker's going to be coming on soon, I've got 4 minutes left. I'm going to hand back to Jeanette, because if you need to get a glass of water, it'll give you a couple of minutes to do that. So Jeanette, are you there? Are you still awake?
Are you kidding me? Awake. I live and breathe this stuff. And I love this part. Like I've always, when you started out and said that, you know, the clean charts or BS, and I was like, this guy's, what is he about to say? Because I was raised in the S&P, like, I mean, like before you could even electronically execute. And I learned tape read, you know, so for me, I was a tape reader, right? So I really didn't need a big chart. I would just pull the numbers off. I would pull the numbers off the chart, write them down, and then I would just trade the numbers. I wouldn't even look at a chart. And so when I was looking at yours, I was like, what in the heck? But then the more you described it, I was like, oh, hell, this makes a lot of sense. Like it really, you know, and really it comes down to, you know, what works for you. And you've mastered this, obviously. So
absolutely.
Pretty good stuff. Okay, so what I'm going to do next is, all right, guys, his link is jigsawtrading.com/TradeThirsty. I'm going to dismiss you, Peter.
Thank you, Jeanette. And,
you're welcome. All right. Let me dismiss you real quick. Thank you so much.